Toronto housing lies? Is affordability actually even possible? Stay tuned to find out on this week's episode of Prime Props TV. Promise you, it'll be worth it. Good day, Toronto. Welcome to another episode of Prime Props TV. So glad you could join me here today. On this week's reaction video, we're going to cover 5 topics. The first one is the lie that we were sold about Toronto housing and affordability, because let's be real, it's not really there. Then we got housing has cooled, whether it should be celebrated or be completely concerned, depending on where you are in the market. We also got rents are on the rise because of interest rates. And we also got record-breaking pre-construction sales that we're going to go over. And then the last one is a warning sign of a big-time hedge fund managing company called Blackstone coming to Toronto. So without further ado, the first article we got here is what's in it for me? A renter on election and the lie we were sold about. So again, typical with a lot of these pieces, they're written in such a way that there's someone as a narrative to show you kind of what's happening. And I hear these stories more often than you would imagine. And it's really, really unfortunate, right? So this gentleman here, Mike, as a musician, and he also serves on the side. And the idea of being able to buy a home for $250,000 as a down payment is just not possible anymore, right? So even anyone who is making like over $150,000, you have to think about it. $150,000, you're taxed around 40%. Let's just say your take-home pay is somewhere between $90,000. To save $250,000, you essentially have to not pay and eat and only pay taxes for 2.5 years. So even if you have that kind of income and you live in your mom's basement until then, it'll still take you 2.5 years to save up for that. So anyone who hasn't owned any property in GTA is going to have a hard time getting in. And this is kind of the lie that we were sold, because no matter how much you make things affordable, even at the price point we're at, you really need intergenerational kind of real estate assets passed down to you, right? So the bank of mom and dad giving you that down payment. What person realistically is going to be able to save that kind of money really quickly, right? It's really, really tough. Granted, I know some people have done it, but for most people, it's very, very difficult, right? So when you're going through this, the big quote here is that, we were told when we were younger to work hard, get a good education, bootstrap, but it's all BS, and I completely agree. I learned, fortunately, but also unfortunately the hard way when I got laid off via email younger in my career, that working for somebody isn't really going to get you there, because the amount of money that you're saving plus the cost of living, unless your wage is exponentially growing really high, it's very difficult to keep up, right? Unless you're honestly coming out as like a software engineer making 200 grand, it's very difficult to be able to afford something on your own. And when you're at that over $1 million price point where you have to have more than 20% to as a down payment, then you're really kind of stuck to get $200,000. Whereas if you're at least under $1 million, you can still do the whole 5 to 7.5%. And that's why I'm pretty sure at some point when the market slows down enough and then the government needs to kind of juice it back up, they're going to change that rule and increase it to like 1.25 mil, right? With less than 20% down. But the idea here is, work hard, go to school, get good grades. It's kind of BS. It really is. It should be more like have rich parents. That's really kind of it. Now, one of the things I highlight here is that a lot of people think that taxing investment properties are the way to go. And I think there should be if they're trying to slow down the market. But it's kind of that double-edged sword where if you tax investment properties, then the tax base comes down and then that reduces the income for the city. And that's kind of an issue and that they're trying to juggle between, right? And that's why there's no real good way to fix it. But when you kind of read it from this person's perspective, where you're saying he basically served a woman that had 25 properties and it shouldn't be that easy, that's the problem right there. If you've been in the game in real estate investing as long as I have, you'll know that back in like 06, 07, you could do 0% down, 40-year amortization, right? Because the rules are so loosey-goosey that it's just only been getting tighter and tighter in the last like 5 to 10 years. And if you've been in the game since like 08, your gains have been like crazy. The prices have actually tripled in a lot of places, right? So if you imagine when you bought your property, that kind of sets where you are going to be in life. And I talked about this in a different video. You can check it out here, because it's not about how well you do. It's just about when you bought that property, because it's the whole income to housing prices just don't match anymore. And while a lot of people think that metric should be a thing, it just isn't, when the fact that we're not building enough and there's still so much demand coming in, right? Like if the governments are really serious about kind of clamping down on investors, we would have seen some kind of talk about increasing the down payment in the last little fiasco that happened in February, but nothing came out in the fiscal kind of budget, right? So that's why you got to look at like, hey, these guys are saying this, but they're doing this, right? And when I look at it, the governments aren't trying to do enough to kind of curb the investor demand. And maybe they'll do it at some point when there's enough backlash from people who don't own homes. But right now, when your home ownership is still 60%, that's a big base of your voter group. Until that changes, where they're not the big base of the voter group for the people who want to get elected, right? Then it's going to stay that way, right? Because it's just political pandering. So, which kind of leads me to article number 2, right? Which is the market has kind of cooled, but should you be celebrating or should you be scared? So this article is, again, written from a narrative of like a family member and kind of telling their story. But this is actually going to blow your mind because when you kind of put it in perspective, it's wild. So this one says that here that this person who was working in the mailroom could have bought a home that's 3-bedroom for $250,000, but he didn't want to stretch himself. And this was back in 17 years ago. So 2006, I think. Actually, it doesn't say the date. So let's just say when it was 17 years ago, right? And he's been working really hard and now he's a lawyer, and that exact same house across the street is 1.43 mil, and he can buy the same amount of home despite how much work he's done. So this goes back to the first article we were talking about, like, is housing affordability alive? Because if you understand some of these things where like what money can actually buy, the whole system is kind of rigged, right? Not that, working hard is not working. It's just that it is working, but when you're kind of swimming upstream against the current coming down against you, which is the government devaluing the money you're working so hard to earn, it makes the house, not that it's cost you more, it's that the money you're earning costs less, right? That's kind of the problem in the world we're in. It's essentially a Ponzi scheme. So if you can't get onto the Ponzi, meaning own a home, then you're kind of at risk because there's so much against you, right? This is why it's like, if you can get in the market, because you can trade real estate assets. But if you can't, there's going to be a part where you're going to be priced out forever and you're going to be a renter for life, right? So when you go on to like more of this article, right, they're going to be talking about this person from Royal LePage, who is an expert, Sofer, points out how many times that there was a dip in the market, right? So when you kind of go down, I highlighted part in green where we're comparing, US in 08 when they had the great financial crisis and the whole housing crisis meltdown versus to where we are right now, and if that's what we're seeing. So one of the key things that I highlighted here is that we have a very stringent way of getting mortgages, and it's a good thing. And when you're getting a mortgage, it's a huge pain in the butt. But when you are in the system, we're a lot more stringent, and that's good for us because we're not giving out loans to anybody, which is what we saw in 08, right? So in 08, US was giving out what we call ninja loans, right? So ninja, N-I-N-J-A, no income, no job applications. So there were rumors about, pets getting loans for these houses, and that's why there was a whole giant card system that got collapsed. I'm not saying that systemically there isn't a problem in the mortgage industry in Canada, because I'm sure as prices go up, there's fraudulent stuff, or the stress test is kind of sidestepped by adding someone else onto a title. So there is inherent like systemic risk there, but it's not as bad as just giving out money to a pet, right? So it's a little bit better, and that I think we should be able to handle any kind of financial stress that we are going to get. Handle it in a sense where we're not going to be like US, hopefully, knock on wood, right? So we're just less kind of at risk like we had US, but we are still at risk. And I just don't know where that is depending on how quickly the market deaccelerates or accelerates, right? Now, one of the things that they're talking about here is that in a market where prices are growing really, really quickly, and realtors were just holding on these two properties and buying it themselves and selling it later, kind of like a speculation flip, not that they're renovating it, then that's kind of the height of the market. I didn't personally see that in January, February, but I did see a lot of people jump in to try to buy a property, hold on to it, and sell it later. That's why we got those kind of anti-flipping speculation taxes that are coming. But if you are like a renovator or flipper, right, you add value to it, then you're still fine, because as long as you buy the property correctly, you have the skills in between to renovate and to sell it, you're still fine. It's just the people who are buying and doing nothing, sitting on it, are the ones at risk, right? Now, he's saying that if you're a young family looking to kind of get into the market, that's kind of where things are going to get really tough, kind of like the two articles from the narrative that I was describing, right? Especially if you are just about to separate, because it's so difficult to get into the market right now that even if the market is coming down, and some people who are kind of waiting on the sideline, those people aren't celebrating because the prices are still very high. And that's what I'm saying. Housing affordability is kind of like a lie that we've been sold to. Like, at what point is it actually affordable, right? Is it affordable to you? Is it affordable to the guy who has $1 million? Or is it affordable to the person that next street who is kind of above average income? Everyone's level of affordability is just different, right? So that's why you have to understand that where you are in life, whether you want to own a home or not, really is dictated about, unfortunately, whether you own or your family owns any real estate right now. And you would really need like say even a 50% correction, is not going to bring us that much more affordable. Because if we're say at $1.2 million right now, go half, and assuming it goes half, I don't think it's going to get there, but let's just say your average home becomes $600,000. To qualify that by yourself, you still need like $100,000 income, and you still need down payment, right? So the affordability factor is going to be based on where you are financially, right? Now, the next point I want to point out, highlighted in blue here, is that the interesting thing is anyone who is on the sideline right now, and I've said this before, because everyone's always like, I'm waiting to buy when there's a crash, whatever, right? But you realize in an environment we're in economically, when the rates go up, your cost to carry that property also goes up. So if you buy something for $1 million, it's at 2% interest, or you buy something at $900,000 at 3% interest, technically the monthly payments on both of those are exactly the same thing. It's just you bought for something less, right? So you have to understand that why prices are falling down. And if they're falling down because of rate increase and you're just concerned about your monthly payment, which everyone is because they're just buying a monthly payment for the house, you're kind of perpetually, paying down off this loan, then your monthly payment's the same. Your affordability is the same thing. Think about that, right? Because prices went up like crazy because there was so much money and rates were low. So the final thing here I'm going to point out that they're saying here is that this person doesn't think that there's any scenario where the short-term drop is going to be made up again, meaning that he's saying that there's an undersupply of homes and information is coming, which is kind of what I've talked about a lot. And again, I have a video coming on that later, but it's just the macro trends are good for real estate housing prices. But in the short term, interest rates going up is bad for it. So some people, again, are saying this is like 2017. Some people are calling for like 1990s, right? Again, no one will know. You just have to navigate it yourself. But one of the things that I really want to highlight over here is that it's very difficult to explain this to a buyer and a seller, and they neither understand both sides of it, right? And let me try. So if you're a buyer, you obviously want your house that you're trying to buy be as low as possible. If you're a seller, you obviously want the price to be as high as possible. And everyone, if they have a home, they're like, okay, housing affordability is great. But when you're buying, you want affordability to even lower and lower. So everyone wants affordable homes, but nobody wants their own home to be affordable. So you're kind of having sellers and buyers always clashing, and it's not a zero-sum game. You see what I mean? So when you have more people who eventually want to get into homes, how affordable can you make these homes realistically if there's so much demand coming in, or if there's enough supply to kind of cover it up? So that's kind of the supply equation that we're always juggling with. Everyone wants to say, hey, housing should be affordable for everybody, but it's never the case when it comes to their own. You see what I mean? So that's kind of why it's so difficult to kind of make these things work, because no matter how altruistic you think you are and you kind of want affordability for everybody, when it comes to yours, when the tables are switched onto your side, you're going to want to sell for the most money possible, right? It's the same thing when people are like, hey, we should ban blind bidding. But when you're the one selling, you're like, no, blind bidding all day, every day. See what I mean? Tables are always turned depending on your position. Now we got the next article here. Some new landlords are losing money with rates rising and tenants could see rent hikes. So while this is a very good catchy headline, rents usually rise with interest rates. And how I'm going to kind of show you that trend is that when people who are about to buy, kind of like they saw in January, February, and they're no longer buying, they're holding on to some money. They're like, you know what, this market's too crazy. I'm not going to buy. So they end up renting. So there's a big inflection point where everyone goes into the rental market. Then rental market is also seasonal, right? So in the April, May, June months, everyone tends to move. So there's a lot of demand. So the rental market picks up quite a bit. And when we're having that mix of, no one buying any homes right now because they're freaking out the world's going to end. So those would-be home buyers are going to renting, and the seasonal renters are also renting. It's causing kind of a log jam in the rental space, especially if for like freehold homes where someone wants to raise a family, right? Now, the other thing is when interest rates go up, the landlords need to recoup some costs because they're cash flow negative, right? So they're going to increase rates as well. But obviously there's a lot of landlord-tenant boards in between on how much you can and cannot increase rent. Now, the interesting thing here that I have highlighted here is that we're talking about cash flow negative properties. So right now, if you were to buy a condo right now, on average, your carrying cost is going to be way higher than your rent that you're collecting. So according to Realosophy right now, the average condo is about minus $492 a month at the current interest rate. That's generally, I would say, about correct. That's kind of what we've been seeing with some of our clients. And when you kind of see cash flow negative and you're paying out of pocket every single month $500, and you see the headlines like, oh, the world's going to burn, the markets are collapsing, sales are down, right? That's when you freak out and you sell, right? That's kind of why, if the prices are constantly going up, like I was saying here, the capitalism is that cash flow negative is fine, but when you have low interest rates, people are paying down your principal, right? Plus that your property is growing up in so much in value, people are like, yeah, I can carry the $500 a month. But when you are watching the headlines saying that, everything is not selling, the market's going to crash, the bubble's going to burst, you're like, why am I paying $500 out of pocket? And this is kind of why I've always been saying, like, you need to have cash flow positive properties. And that's kind of why I have a method to my madness, because in situations like this, where the world looks like it's going to flip upside down, if your property is paying for itself, it's irrelevant whether it's worth $1, $10, or $10 million, because at the end of the day, you're not selling that property at an inopportune time. But when you're cash flow negative and you're paying out of pocket every single time and you're losing equity, story's totally different, right? So that's why, again, this is not to toot our own horn or anything, but that's what you need to understand when you're investing, all the pros and cons. I've been doing this long enough and I've seen a whole bunch of wacky stuff before. And when the numbers don't work, they just don't work. But when kind of the market's, like gravy train, everything's going up, everybody looks like a genius. But it's like the whole Buffett thing, when the tide comes, you'll see who's swimming naked. And these people who are cash flow negative of $500 a month without other investments to offset it, they're swimming naked, and we'll see where it's going to take them, right? So, and that's kind of exactly why, when interest rates continue going up some more, right? They're like, oh man, my negative keeps going higher and higher, or lower. You get more and more negative, right? And then that's when they're like, okay, maybe I'll sell, and they sell at a loss. And that's kind of where there could be some price discovery going down, because these are the unsophisticated investors. They don't understand how to do it, and they just thought real estate was a get rich quick scheme. Now, if this is the type of real estate content you enjoy, make sure to help us spread the knowledge by smashing that like button and subscribing to the Prime Property channel, because every week we make awesome content like this and give you an idea of what's going on in the market, reading these headlines to let you know what's going on in the market, so that we can be honest and transparent with what's going on, because we want you to think of us whenever you're buying, selling, or investing, be like, Zhen and his team, they're really good. And you'll book a call with me to kind of strategize what you plan to do with your real estate future, right? So you can do that by using the link right here. It's www.chatwithzen.com. So back to my next article I have over here, which is from Urban Nation, saying that GTA new condo sales reach record high in Q1 of 2022. This is absolutely wild, and I'll show you why. So over here, you can see that there's a chart of how many pre-construction condos are sold. And it's very difficult to kind of track these because these aren't on MLS. So Urban Nation does a good job in kind of collecting this data. You can see over here that at the kind of crazy frenzy of pre-construction, even when we're selling pre-construction because it still made sense, there was 8,000 units that got traded, people bought from the builders in Q1 in 2017. I remember that was peak frenzy. I think the spring was also just as crazy as well. But you can see right here, across the line, in Q1 2022, we just surpassed the 2017 frenzy. And that is obviously wild, because if you think about it, pre-construction prices haven't gone down since then. Interest rates are so low, people were paying into it. And I do think there's a lot of people who bought into it thinking they were going to sign, right? Now, the challenge in kind of having such a crazy pre-construction market is that anyone who's bought into pre-construction, you have to understand why we stopped selling it. It was because the numbers didn't make any sense, right? So back in 2017, you could buy condos downtown for about $1,000 a foot. And at $1,000 a foot, you need $4 a foot in rent to make it break even at the 2.3 interest rate that's right now, right? So that would be about, if you bought something $500,000, a one bedroom, 500 square feet times 4, $2,000 in rent, one bedroom. Sure, no problem, right? Now, if you're buying this, you're at $1,600 a foot, and at 2.3% interest rate, you're looking at $6.40. So if you're buying at that, call it your one bedroom is like $480, let's just right now. So you're gonna need about like $2,800 in rent just to justify it's $1,600 a month. And this is before your carrying cost of taxes and maintenance fee. So that's why for us, it hasn't made sense. But if you kind of just look at the amount of unsold inventory over here, it's very low. It's the second lowest we've ever seen in Q1 period. So that means this inventory is being gobbled up. And like I was saying, it's not that some of these don't make sense. It's like some of them, they do make sense for some people, right? But it's just like if you need a store of value somewhere because money keeps getting debased, pre-construction is the least kind of troublesome kind of real estate investment you can do, because you just sign a contract and put the money towards it. And this is exactly what I was talking about, right? So this is kind of the growth in how much the cost per foot is going. So you can see on the right-hand side, it's now on average in Toronto about $1,381. So this includes GTA. And you can see on the left-hand side, it's just how much the unsold inventory is. And I've always said this, like if you're trying to look for a good deal, you may want to look for stuff that hasn't sold yet, that hasn't increased in price, because there's not as much hype going around it. And there are some deals to be had, but you just got to be extra careful when you're buying pre-construction, because I have another video coming up on Thursday about the appraisal risk. And I also have my lawyer coming on the show on Saturday to talk about defaults and all that stuff, because when the market's going up, everything looks great, right? But when the market's coming down, that's kind of like I was saying earlier, you'll see who actually has good advice on their side and if they're exposed to any risk. Because there's a lot of people right now who are kind of in a really messed up situation where they're underappraising, they're not able to sell their home, or their pre-construction like homes that they bought, like freehold homes, are under market, and now they're about to close and expect, and then they don't have the money to close because they underappraised, right? So these are all things that are kind of crazy that it's coming up, and that's why I'm putting a sequence of all these videos to kind of give you guys the knowledge of what's going on. Right? And now the last article I have here, this one's just interesting. So Blackstone, for anyone who doesn't know, it's like a giant hedge fund that basically manages a lot of money, and they promise yield for people. And now they are coming to Toronto. They've been buying up residential properties in the US in the last few years, ever since I think the pandemic. And now they are officially coming saying that they are buying residential properties on top of their industrial portfolio in Toronto. There's been a lot of talks about this even prior. I think a company called Core was buying stuff up in the southern Ontario area, like the Golden Horseshoe. And if BlackRock comes with like the $1 trillion balance sheet, oh boy. And this is where it comes back full circle, is housing affordability. Are we doing enough to make it affordable, or is this just a lie we've been all kind of given, right? I think it's just all a lie, because I don't see politicians doing the things to make things affordable, even if they're trying to, and they're just saying the right things, but doing the exact opposite. And that's kind of the whole point of this article and all these videos and articles I picked up for you this week, so that you can actually understand what's going on. Now, whether you decide to do something about this is totally up to you. Like, I know some people have moved out of Toronto because they're like, Toronto's stupid. I know some people are like, you know what, let's just buckle down because we just want to raise a family. Everyone's situation is different, right? That's why I'm trying to give you this information for you to have some critical thinking and understand what's going on, because the market's going up, going down, depending on who you're talking to. Prices are up, prices are down, depending on which data you're collecting from, right? So if you are looking for some real estate help, whether you're trying to buy, sell, or invest, you can book a call with me using the link right here. Otherwise, hope this gives you an idea of what's going on. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.